We haven't sold that aggressively. I mean, if you look at it, during the course of 2010, we sold a very small amount of the stock.
And that was Warren Buffett back in March talking about selling shares of Moody's. Berkshire Hathaway has taken its stake in the rating agency down from 20% to 12.5% over the past 2 years. But it sure looks like Buffett left a boatload of profit on the table. Moody's shares are up 96% over the past year. So was it a rare Buffett blunder to bail on Moody's? And who's making money right now on the rating agency's run? Joining us now is Lee Munson, CIO at Portfolio LLC, and Ed Acherino, Managing Director at the Benchmark Company, with both on buys on Moody's and S&P. All right, Lee, I know Buffett still owns more than 28 million shares and 12.5% of the company, but did he blow it on this one?
No, I don't think so. We have to look at what he was doing back in 2009 when he started selling it. He said he sold Moody's along with 3 other companies to do what? He said, I need this capital to buy Dow and Swiss Re. Moody's has been a double since those 2009 lows, but Dow and Swiss Re are up 200, 300%. So while we'd love to think that the guy who's 80 years old is having a senior moment, the facts remain that he got on a faster horse and made more than double the amount of profit with what he used that money with. In fact, he would have done a lot better if he would have sold all of his Moody's and put all of it into Dow and Swiss Re back in 2009.
That's a very interesting point. If we just take a step back for a second and take a look at whether or not these remain really good investments, Ed, you've got a buy on both Moody's and McGraw-Hill, which is, of course, S&P. Do you feel that the credibility of the ratings agencies have come back? I mean, obviously, they were criticized so much. They were slammed for failing to warn of the risks ahead of the GFC. And now it feels as if they're all powerful when you look at what they're doing to Europe.
Well, there was always a great deal of misunderstanding what the credit agencies do and do not. They were criticized because the value of the bonds went down, people lost money. What the credit agencies do is predict default. And their record on that, if you look at the statistics, was not all that bad. It wasn't really their fault. They were part of the problem along with lots of other people. In the meantime, since then, nobody's criticized the rating agencies. The ratings have done what they're supposed to do. They're adjusting ratings, reflecting financial conditions, and it's business as usual. We just had an extremely unusual and very difficult period where sort of the rules got broken and they got tarred with a lot of stuff that they shouldn't have been tarred with.
Lee, I hear your point. I hear your point on the money.
I'm not going to be an apologist for that.
I'm
not going to be an apologist for that. I don't think that the rating companies should get off this easily. The rating companies are popular right now because we have a 30-year run in bond yields going down. There's a lot of investors that are it's very popular to look for higher yields and to chase things, just like the Greek debt. But all these rating companies are doing are still continuing to rent out these rubber stamps. It's like asking an oil company, paying them money to fix up their own spill.
But do you see their business model changing? Do you see their business model changing then, Lee?
Well, I see it changing into getting more things like trying to rate credit default swaps, trying to get more involved in the sovereign debt. But, it's not like the rating agencies, a year ago were saying that Greeks were defaulting. They're always a lagging indicator. I don't think that they add value, and I don't think investors should look to them when they're looking to try to gain higher yield, because I always think that credit agencies are always going to be late to the game. And it's not just defaults that I'm concerned about here. It's a decline in value on a company that's going down. It's too slow. I don't think they add value to the market.
Rating agencies don't predict value. They don't predict price. What they tell you is the probability a company is going to get in trouble. Mm-hmm. They have to be late because they're looking at historical numbers. They don't estimate. They don't predict. They don't forecast. They look at an existing set of statistics against a standard and create a rating. That's it.
Lee and
It's rather simple.
Great discussion. Thank you very much for that.